Is the bubble going to burst? Is there a crash happening? Is it 2008 all over again? What's up, guys? Louis Gault here. Welcome back to the channel. We are Central Park experts here in Denver, Colorado, selling and buying homes with our clients all over the place. So today we wanted to address something that we've been getting a lot of questions on, which is what's happening? Is there going to be a crash? Is the world coming to an end? What is happening? And I wanted to get on an expert, a friend of mine, Reno, who is a lender who's been in the business since like 2006. So he's been through it all. I wanted to get his expertise on why the market right now is different and way stronger than the market was back there. Some of the things that made that crash happen that were not so good, a little bit sketchy, and then, go from there. So I want to welcome Reno onto the channel. Check it out. We are joined by my good buddy, I know him as Reno, Reno Saenger, who is an awesome lender here. You just live right up the road from me, not too far away at all. I've known Reno for a few years here. I wanted to get him on to chat about things that are going on and things that happened in the past, because you've been in the game for such a long time, and kind of, Reno, the questions I get mostly are like, is this a bubble? Is the bubble going to burst? Like, what's happening? Because this seems like insane right now. So I'll let you kind of introduce yourself, and then we can just jump in and start chatting about this stuff.
Perfect. I appreciate it, Louis. Nice to chat with you. So people in the industry know me as Steve, Reno, both. It's middle name, so go by both. Anyways, I've been originating loans since 2001, and just wanted to chat today kind of about what happened in 2008 and what's going on today. And, to just speak with experience. Obviously, no one has a crystal ball. So everyone, no one knows what the future really is going to hold, but we can look at the past and kind of evaluate on what might happen. And really the lead up. So to talk about kind of what happened in 2006, 2007, the lead up to the financial crash in '08 is, a lot different than what we're seeing today. One, loans in that era were a lot riskier. The two biggest loans I want to talk about were what were called the 228s and the 327s. These were subprime loans that were highly leveraged that we originated. In the old days, I mean, people that are in the mortgage game would know about the option ones, the new centuries, the WAMUs of the world. These were, but these subprime loans, what they were designed to do is they'd have like a 2-year fixed window. So you'd have a 2-year fixed loan at like, let's say 4.5%. And then after that 2-year fix or that 3-year fixed window, it would move into an adjustable phase. Now it was an ARM, but normal ARMs, like conventional ARMs that are Fannie Freddie loans, they're going to have a margin of like 2.25%. Or 2.5, so when you go into that adjustable phase, you're going to add the margin to the index, and the index would be what would fluctuate, like a LIBOR index, or, you had different economic indices that you would follow, and you'd add those two together, and then that would be your rate for the next year. Well, when you add 2.25 to like 2%, you'd maybe adjust to 4.25. Now, the margin is always set, but on these subprime loans, what was happening is they were setting these margins at like 8 or 9%. So you'd have a start rate of 4. And the whole idea is it's like, oh, hey, Mr. Borrower, Mrs. Borrower, after this 2-year window, your home's going to appreciate. We'll switch you into a, more of a conventional product and get you out of this loan. Well, that was leading up to '08. And what happened was that, as we started seeing this domino effect, homes starting to foreclose and, things starting to break down, those particular loans, specifically, people would adjust to, 10% on a loan, and their mortgage payments would double. And they were highly leveraged at the time. So they maybe were at 100% financing when they bought the house. So now all of a sudden you've got a borrower that had a $2,000 a month mortgage payment. It goes to $4,000 a month, and they have no equity in their house. So they started walking away from those loans. So that was a big deal. And that brought everything down. And no one thought that that would happen. And not to get into, why those loans were created, but those loans were there. And people were highly leveraged, not a lot of equity in their house. So today, I mean, we're in a much different situation where it's a basic economics of supply and demand. I mean, we have a limited supply, we have strong buyer demand, and honestly, I don't think we're going to have a situation where everything just blows up, where people have tons of equity in their house. It's just a way different situation this time around, where we're not going to have like a foreclosure epidemic. If anything, these higher rates are going to kind of create some normalization. And in all honesty, like, now's it's still a great time, like time to buy. I mean, we're still going to see appreciations of probably 8 to 10%. I mean, maybe less over the next couple of years. So you think, well, mortgage rates are maybe a point or 2% higher than the average of where they've been over the last maybe 10 years, but still, that higher interest rate is less than the appreciation that you can generate in your home. And chances are down the road, as things normalize, and these rates will come back and people can refi and lower their costs at that point in time. So yeah, I think.
Yeah, because that's the interesting part, is because I wasn't in the business in 2008. So there's always this, I think, even from myself and a lot of realtors who weren't, it's like 2008, it's like this big scary time, this crash that happened, but a lot of us don't really understand what happened. There's like movies out there, like The Big Short and stuff like that. Right. I'm watching that and I'm like, I don't understand this movie at all. So there's like, stuff going on like that. But the big thing with the buyers that we're seeing right now is that they're way more qualified. They're over like 700 credit scores. They're putting 20%, 25% down on, on the average. It seems like the millennial generation has kind of come up, and, all of a sudden, we used to make fun of them for being millennials and stuff, but it seems like they've become a very, very strong, financial part of our industry.
Oh, definitely. I mean, and now, the millennials are getting to that age of 30. The average millennial age is now 30, and that's usually the time you buy your first house on average. And so, yeah, I mean, they're entering the market. There's a ton of demand from that generation. And talk about kind of The Big Short and what happened there. And I didn't really explain that, but, really what happened were these mortgages were they were pulled together and sold as mortgage-backed securities. So, people would buy them as an investment, as a mortgage-backed security. And what was happening was these investment bankers like Lehman Brothers and Goldman Sachs were going to the marketplace. They were going to these accredited investors. They people that can only buy AAA stuff. So, these are money managers that are managing a pension fund for, Denver or for certain cities. And what they would say is like, hey, you can go buy this mortgage-backed security from Fannie or Freddie, and it's going to pay a 3% return. Or you can buy ours. It's still AAA rated by the S&P, and we'll give you a 5% return. So people were like, yeah, we'll sign up for that. So there was this massive flow of money coming in, and those investment bankers were coming back to the street to people like us and saying, hey, bring us more loans. We're able to, because what would happen is you would fund a loan as a lender, keep it on your books for 90 days, and then slough it off to the investment banker, who then would sell it as a mortgage-backed security. No one thought these subprime loans would bring everything down, but it did. And that just does not exist today. That environment, I mean, for the last, 10 years, all of the loans that we do are mostly fully documented. So, in that area, you had like no income, no asset loans. Those loans just are there, but they're far and few between. So yeah, I mean, market's not gonna. There's not like a switch that's just gonna turn off like that.
Right. Yeah. And I mean, as we know, like we're working on a deal just now. I mean, today, if you're watching this back, it's May the 3rd of 2022. But even today, our client got, beaten an offer with 13 offers, 13
and we,
on a
right.
condo.
Yeah. Yeah. I mean, it's crazy. It's still, and rates have gone up. I mean, we're on second home and investment property condos in the mountains. We're in the high fives, low sixes right now, but you know, the demand is still there. I don't, you know, it might stabilize, which I think is probably what's going to happen. We're probably going to start seeing more of a plateau effect, but with a normalization, and that's so yeah. I mean, you know, in my opinion, we're still in a strong market, and if people are out there looking, it's still a good time.
What do you see happening with these interest rates? Because it's funny, we lost a few clients recently just because they got priced out. You know, like we've been working with them for a good like 6 months or so, and it was like, well, they're just going to wait. And it's like, well, listen, here's what's going to happen. Like these interest rates are going to climb, and because of that, your monthly payment goes up and your buying power goes down. And most of them listened, but there's a couple who just got priced out, and it's super sad. And it's not like, oh, we told you, but you know, it's hard because you're trying to explain this to people, and you know, it's challenging. But I still feel like we're in the thick of it. I'm not sure we're at the peak of interest rates yet. So, what's your take on that?
Yeah, I mean, you know, we've got a Fed meeting today and tomorrow, and so tomorrow we're going to learn a lot more about what the Fed will do. The anticipation is they're going to raise the federal fund rate another 0.5%, which will cause rates to continue to rise. And you know, the unfortunate thing of what the Fed is doing right now, and why they're raising rates is they are trying to curb that demand to control the inflation, control those home appreciation. So their tool is to raise rates. They're going to continue to do it. So if you qualify for a home now and you know you're there, yeah, I mean, take advantage of it now, because in 6-8 months, we're still going to have higher rates and we're still going to have home appreciation. And so at that point, you could be priced out of the market. So there's no, you know, this idea like, hey, let's just wait. I mean, who knows, like that, you know, sure, maybe in 5-6 years, I don't know, something could happen and home values. But if you're trying to buy a new home and you're trying to get into the market, yeah, I mean, in my opinion, like things are just going to get more expensive, at least for the next 12 to 24 months. The Feds aren't done.
Yeah. And I think that's the overall picture for us, Mackenzie and I, when we talk to people, it's like, hey, if you need a house or if you want to buy a house, like buy one, you know, like buy one within your means, you know, and make sure that you're not house poor and stuff like that. But like pull the trigger on something if you do need a house or you want to buy a house. It's like when you're trying to beat the market, no one can do it, you know. I was reading something yesterday about Malcolm Gladwell. Is it Malcolm Gladwell, the financial guy? He was talking about, he made $1 million bet over 10 years with these hedge fund people, and they were going to try and manipulate and beat the market. And he was just investing in index funds and just letting them sit. And these people who are working in and out every day, trying to beat the market, you know, buy and sell and all this, his index fund grew substantially higher than his. And I think the lesson there is like, sit on it and wait. You know, it's like if you're budgeted for it, if you feel good about what you can afford, get there and then wait it out. You know, you're going to grow equity, and if interest rates do drop down eventually, you can refinance into something like that. You know, so I think, you know,
very true.
Even for us who are in the industry, we don't try and beat the market, you know. So for the average consumer who's just trying to buy a home, like to time the market is just bonkers.
Yeah, it is bonkers. And yeah, you're right. It's not like a day trade. I mean, you're buying this house, it's a buy and hold strategy. You're going to hold the home for, you know, 5-10 years. You're going to do well. You're going to make money. And to sit there and say, well, I'm going to wait, you know, like if you're in the market in the next 12 months, I mean, I would say time is of the essence. Buy now, because it's not going to drop in the next 12 months. I mean, I can say that with pretty much 99% certainty. Now I can't, you know, you start going 2, 3, 5 years out, it's hard to say what's going to happen.
Mm.
But in the next 12 months, it's pretty clear. I mean, we're going to continue to have home appreciation. We're going to continue to have higher rates. So I would say certainly, like if you can find a house that you like and it fits your means, certainly do it now.
Yeah. Yeah, for sure, man. Now, switching subjects a little bit to you and your business and what you do. So you have your own company, right?
That's correct. So I'm a mortgage broker. So we, I think mortgage brokers offer a competitive advantage in the marketplace. There's different types of, loan origination out there. I mean, you can be a retail loan officer who works for a retail bank, who you're just stuck with their products, what they offer. Or you can be, more of a mortgage broker where I can shop the market. I mean, I'm always out there trying to find the best deal for the consumer. I have, 20, 30 different investors that I work with at any given time. We have to have wholesale relationships with these banks and continue to keep our financials intact. And but we move quick. I mean, I can work with different lenders that have different products, different processes, but we're closing in 2 to 3 weeks if you need to get a deal done. And we're super competitive. So I own the company. I've owned it since 2006. Actually started it right.
That's wild.
It was wild, but to lead up to that, I've done everything. I've worked retail, I've done correspondent lending, and then I've done wholesale. I've had a warehouse line and all that. But I think the broker community and the wholesale channel is the best option for the consumer. And we don't have the marketing power of a Chase or a Wells Fargo, but we're on the streets, we're doing grassroots marketing, talking to realtors like yourself, and just trying to educate the consumer, let people know, hey, we've got the cheapest rates out there. And I think most people watch this and live in Central Park know that about
and that's the big thing as well. Yeah. Well, it's the education piece as well. I think that's vital, it's for realtors as well, and lenders. It's like, people can go and shop with whoever and use whoever to buy homes and stuff. But, the education piece is massive for us. And that's what we like doing, and helping people through and making sure they understand what's going on. And, that's why, partnering with you is a huge deal for us, especially living in Central Park and what we're trying to do here with the community. So yeah, it's massive. Well, any final thoughts for people before we sign off here?
No, I appreciate the time. I appreciate you having me on, and I enjoy working with you. And I think now time is of the essence. Carpe diem, seize the day.
That's it. Well, I'll put Reno's details in the description or the comments wherever you are watching this. But definitely reach out if you want someone who's going to shoot you straight, who's been in the industry for a long ass time, who knows what it's talking about, has gone through the crashes, has come up through everything else. Then definitely reach out and chat with him. Worthwhile person to know, and he's also awesome as well, so that makes it worthwhile. Ton of fun.
Louis, you're the man. I appreciate it. Thanks for
all right
I'll
talk to you soon.
Okay, thank you.
There you go, guys. Thank you so much to Reno for coming on the channel. I really appreciate that conversation. As you can see, we're on a much different trajectory than we were in 2008. Bubbles, crashes, all that stuff. But, if your mind isn't quite at ease yet, feel free to reach out to us, Reno or myself, to ask more questions about what is happening. So thank you so much for tuning in. If you have any questions about Central Park or Denver in general, we are here. We are living, working, and breathing in this neighborhood. We love it here, and would love to help you too. So reach out, and I'll see you next time.